Good evening, everybody. Welcome to Real Invest Webcast episode 009. This is Joseph Ola, your realtor here at Southern Ontario. Um, I reside in Niagara area, but I cover the entire Southern Ontario, from Niagara to Hamilton, GTA, Greater London area as well. And I'm glad to bring you another episode of the Real Invest Webcast today, where we chronicle the journeys of real estate investors as well as interviewing professionals in the field to make sure that your journey as a real estate investor is a great and successful one. Um, Here in Southern Ontario, things have been changing dynamically as it is everywhere on the world. So it's more important than ever to stay apart and at pace with what's going on. So thanks for joining the show once again. My name is Joseph Paula. And if you are joining on YouTube, make sure to subscribe and like and share the link. If you're joining on Facebook and Instagram, please make sure to share and like as well. And today's episode, I'm going to be by myself chatting with you about some of the questions that I've seen coming in the past week. We'll be picking up where we left off regarding the exit strategies of pre-construction investments, and then we'll go on to discuss other investment strategies, and particularly also talk about inflation and how that is affecting the market, um, the housing market, and how you should also perceive the entire economy and the entire inflation situation, interest rates as an investor. That's what we'll be talking about today. So once again, welcome and get your popcorn ready and get zoned in so that you can draw as much as possible into this show. All right. So where do we start from? We're gonna kick off from we kick off from this where we left off last week, and that was about the property that I toured. It was a pre-construction property that an investor got into about maybe 8 months before completion. Now the house is done, and the first strategy employed by the investor is to lease the property out for short term. So it's what you call Airbnb. Um, and that seems to be working great right now, especially because we're in the tourism season right now. So it's perfect for that particular strategy. So the investors, I believe, is cash in flow right now to basically break even. And that's also because when you get into the short term lease market, it takes I mean, the most common platform that we all know is Airbnb. It takes quite a bit for a new property just listed on Airbnb to gain traction to where maybe it gets more reviews, and the more reviews you get, just like any other platforms, the more review you get, the more your product is going to be suggested to other potential customers. So this property is just new on the Airbnb platform, but I think the owner is also looking to put it on different other platforms like Verbo and Bookings.com and all of that. But the property is not doing too bad right now, and I think the questions that I got were around potential exits that the investors could look to. Again, if the property does so well that what it makes in the peak seasons like the summer will cover for everything that's happened in the in I mean, if what is being made in the summer will cover for the entire winter season where there seems to be lower patronage, then this is a perfect strategy, at least as long as it doesn't get flooded or it doesn't get regulated so much that there's not much profit to be made anymore. Right now, short-term leases are doing so well, depending on the location, obviously, that if they continue to do well, there's no reason why this investor should change their strategy. All right. So that's one thing. If it's not broken, don't fix it. Mm. So that's one way to go. The other, by the way, let me just make sure that I'm monitoring the chats here so that if you guys send in any questions, I'm able to respond as soon as I get them. And if you're just joining the show again, it's the Real Invest Webcast, episode 009. And I'm talking about uh, where we left off last week regarding a particular investor going into pre construction property and what he's doing right now with the property and potential other exits. And then we'll be talking about the interest rate hike, we'll be talking about inflation, and how you as an investor should be perceiving the market. Please like the video. If you're on YouTube, make sure to subscribe. If you're on any other platform, like, share it with your friends, and throw in your questions in the comment section. All right. So I just talked about how short-term leases are perfect for the summer. They're perfect for the current market right now. So don't shy away from them. If it's working, don't break it. Just keep it going. Keep steady. Um, Now, if you own a short-term lease, just to give you some understanding about how those work. It's not really a hands-off type investment, except you employ a management company to help you oversee it. Ideally, you're cleaning after every guest leaves, and that could be quite hectic. Not just the cleaning part, but you're also managing the transaction in terms of um, answering questions by your guests, and making sure that you're there if anything's broken that needs to be fixed right away or anything like that. The more responsive you are, the more rating that your guests are going to give you. But again, it can get quite, it can be a lot, because it's just like the regular tenant. They want a lot done, and they want it done quick. So if a guest gets to your home and they have any difficulty entering in, that's a bad first impression. So you have to really be there, like, really quick. So short-term leases could be quite hands-on. um Personally, I'd rather engage a property management company to just handle that for me. And that comes with you parting ways with some significant profit. So it's a trade-off. But if you have the time and you want to grow your portfolio and work full time in the field, then that's not a bad way to handle it. Again, back to exit strategies. What else can the investor do with this property? No brainer is a long-term rent. Long-term rent anywhere from 6 months to a year lease, or just finding a good tenant is the bulk of the work of long-term leases. It is very important that you get someone there that is going to take care of the property as if it's their own, someone who's responsible, someone who has a kind of lifestyle that would ensure that the property doesn't fall apart in a jiffy. And you want to get someone also that that appears to have stable income, stable lifestyle. Um, it could be cruel sometimes when we talk about some of these parameters, like, okay, what of people who don't? But you have to come back to the point where you're thinking about this as a business, right? So if you have a home that you want to put out there for long-term lease, realize that this is a business for you. And if a customer comes to your business and say, "Hey, I'm not gonna pay money. Are you gonna do business with me?" Well, the question is that wise? Even if you do it once or twice, is that a way to do business eventually? No. So if a tenant comes and tells you, "I don't have money to pay," I mean, they won't tell you outright, but when the writings are usually on the wall. You could look at the employment situation, the income situation, and you can really see if this person is able to afford the kind of property you have out there, because that's really what makes or breaks a landlord or an investor. It's really, tenants. Good tenants, man, they're heaven sent. Bad ones, yeah, it could be, it could be, really, really dicey. So long-term leases is a potential exit for, or a potential strategy to digress into uh, from construction. Again, remember that last week we talked about the most investors that get into pre-construction are looking to exit even before closing, right? So that's the primary exit strategy for most construction buyers. They want to, just not have to deal with securing a mortgage loan and all of that. Now we're past that, because this investor, particularly I'm talking about, has closed, so he's holding on the property. He's currently have is holding it as a short-term lease investment, and we're talking about other potential areas that he could diversify into. And we just talked about long-term leases. That's one. Now, thinking about it as a long-term lease as well, this is also property that I believe has a separate entrance where, and it's in the city where a legal basement could be put in place, and the investor could have basically two units in that particular property, and I would say that that would do pretty well for the investor. I can do the math in my head and be confident that the cash flow would be quite, you handsome. So that's one way to look at it. Now, um, beyond those other things, you know what? I'll give a very I paint a very crazy picture here that not too many investors think about real estate this way. Um, a property was bought. I think I gave this story a few episodes ago, but a property was bought for about 650, 700. It was left empty for about 2 years and sold for about 1.2. 700 sold for 1.2. Let's say that the mortgage payment for the property for the entire 2 years was, let's pick something ridiculous. Let's say 4,000 a month. 4,000 a month, that comes up to 40,000, 48,000, 48,000 a year. 48,000, that's 96,000 for the 2 years. 96,000. So let's just round it up to 100,000 for the 2 years. It was purchased 700,000. 100,000 was spent for, on it for 2 years. That means total cost of, of purchase and holding onto the property is 800,000. Now the property has been sold for 1.2. So that's just so much to be said about, you know, what happens if my house is empty. When you think about the bigger picture, then you see that sometimes some of the things that's holding you back as a potential investor is quite trivial, because you have to have a bigger picture. It doesn't mean also that you want a 100% cash flow negative and all of that, but you need to have a bigger picture that, if you lose a month rent, you lose 6 months rent. The question is, and so what? If you're truly playing the long game, then you really don't have much to worry about. That's a point I'm making here. Once again, if anybody's joining us new, this is Real Invest Webcast episode 009. If you join on YouTube, make sure to like and subscribe to the channel, share the video. If you're on Facebook or Instagram as well, do the same. So those are the things to keep in mind. Well, we spent quite a bit of time, and we have about a quarter of an hour to go on the show tonight, because we're going just for 30 minutes. I want to really jump over onto the hot topic of the market today, and that's obviously the interest rate. Everybody's worried about it. Everybody's talking about it. Everybody's jittery. Yeah, but again, big picture is important. But before we dive deep into how this affects real estate, let's just, by the way, I'm no accountant. I'm not a financial analyst. I'm a realtor and a real estate investor. So anything you hear on this show is not a tax advice. It's not an accounting advice, and it's no legal advice. Please make sure to consult your accountant and your lawyer for any of those. Now, what is inflation? Let's start from there so that you understand what the government's trying to do by increasing the interest rate. Inflation is simply um, the increase in value of goods, um, and the drop in the value of money. So money loses value, and goods and services are gaining value. So basically, the amount that it takes in money to buy this phone, for example, maybe it was 1,000 before, now it's about 1,500. Uh, that is what inflation is in essence. It's money losing its value uh, compared to products and and services. So it's a general increase in price and fall in the purchasing value of money. That's inflation. But the question is why? Why are prices increasing, and why is money losing its value? It comes back to the basics of economics: supply and demand. If any item is abundant in the market, then it is of necessity that such item that's abundant will not attract premium prices because anybody can get it anywhere. If it seems expensive in one side of town, then people will go to the other side of town to buy it for cheap, and the side of town that has it too expensive would have to drop their price just to be able to keep going in the same market. So when there's abundant supply, then prices tend to drop. But when there is a limited supply, then prices get tends to rise. That's the same. That's demand and supply in the same breath. So for demand, if there is if so many people want a particular product and service compared to its availability, obviously that the price jumps up, because not because necessarily there's a low supply, but the demand just greatly outweighs the supply. So then why is this bad? It's because if prices just keeps shooting up astronomically, I mean that if demand for something is very high and the price keeps going up, it gets to a point where the majority of the population cannot afford to buy that same that same asset or item, whatever it may be. It becomes, detrimental to the entire economy when everything seems too expensive that a middle class person or the small guy cannot even think of owning that particular item or product. So that's why the government tries to step in. And what does the government try to do to control inflation? What they try to do is shrink demand. Remember that it's the excess of demand that causes um, the price of things to begin to shoot up. Now, the government comes in to try and shrink demand. The way they try to shrink demand is to um, make money less accessible. What do I mean by that? A lot of the money in the market could be from money saved up, but actually in North America here and in most um, first world nations, a lot of the money in the market are actually due to credits. They're from credit cards, they're from loans, they're from line of credits, they're from different credit facilities. Huh? And the way people use that kind of funds is highly dependent on how much they get, uh, how much they pay for using those facilities. So if the interest rate you pay on the money you spent is only 3%, if that's not a lot in your eyes, then you tend to spend more. That means money is cheap. However, if the interest rate you have to pay is super high, then you'll be cautious because you think about that now. If I spend this $100, I'll be paying that $100 back plus another $20. That seems high. If I only have to pay $1 on $100, then I don't mind. But if I have to pay $20 on $100, or if I have to pay $100 on top of $100, then that seems, seems quite high. So that's why increasing the interest rate generally makes money less accessible, or it makes money more expensive, and because of that, people shy away from spending. When people shy away from spending, that drops the demand of products and services. And when demand drops, then prices tend to drop. I hope that makes sense. So that's how the government's trying to battle inflation. Now let's bring it down to the real estate market, which is why you are here, and how you should perceive the market. So yes, uh, interest rates going up, and because of that, many people, I mean, not too many of us are looking to buy uh, our homes cash down. We're looking to loan the value of the house almost entirely. Mostly between 5% and 20% is what comes from us. Others, the other, payment for the house you're buying, for your investment property, is coming from a bank, right? So in that case, the interest rate matters. If you're not paying a lot in interest rate like it was like a year or a year and a half ago, where interest rates were like under 1%, then everybody wanted to buy. Now that interest rates are, getting to like 5%, 6% ish, then everybody had to think. Everybody needs to think twice about, can I even? One of the barriers that creates is even the stress test. Here in Canada, even if you could normally qualify for something because of a stress test, what you qualify for could really diminish, right? So that's what's going on. That's a picture of what's basically happening in the housing market. That's why demand's dr- drastically dropping, and right now, any buyer on the market has quite a few options to choose from. But as an investor, how should you look at this? What the general masses are doing is pulling away from the market, and what that has caused is that there is abundant supply of properties on the market that greatly outweighs the demand on the market. People will continue to act according to their emotions in the long term, at least until the tide changes again. And by the time people decide to jump in, the market would have taken off and probably taken off significantly in the positive direction before people flock in. So, as a savvy investor, how should you be looking at the market? Should you be looking at market sitting on the sideline, or should you be examining the market right now for good deals? Again, if your game is the long term, the market is sort of on its way down. Do you want to get in right now, or you want to wait for the market to bottom up? The problem is that you never know where the bottom is, and you don't know how fast it gets when it shoots back up. We know the market has dropped significantly from where it was a couple of months ago, but what you cannot guarantee is that it's going to keep going down or it's going to stay where it is. So I say that now is the time for an investor to begin to look around and look keenly. This is a time where you could bargain confidently because everybody knows what's happening. Your sellers know what's happening. There are options for you if one deal doesn't work out. So these are not the days where you get to you write offers where there are no conditions at all in your offers just because it's either this property or you have to then scrub the market again for another 6 months before you see anything viable. There are tons and tons of options. Remember, demand has dropped, and because demand has dropped, there are the supply is more abundant. There are options for you as an investor. So you could take your time and pick and choose. You can take your time and bargain and negotiate. So now is the time to do that. Once the market starts picking up again, what's going to happen then is that demand will begin to rise. As demand rises, options drop, supply drop, and then you're back in the competitive realm again. So again, my admonition is that don't, especially if you have assets, if you are liquid right now, don't sit too long on the sidelines. I would say just critically assess the market, and begin to weigh your options, see what the market can avail to you. Um, Generally, take time to bargain hard for what you want to buy, because there are good deals out there. You won't be competing with a whole lot of people, and if you miss a property, so what? There are many others that you can leverage. So that's how I believe investors need to begin to look at this market. Even though it seems like things are on the way south, it just basically makes the market more accessible to you as an investor. It's not for you to just, cower in fears. That's what the general public does. As a savvy investor, it's the time for you to critically take a look at what's going on in the market and be ready to play ball. All right. Leverage the professionals that are that you surrounded yourself with. Myself as a realtor would help you. Mortgage brokers have brought some on this show before. If you need recommendations, reach out to me. Um, Connect with other investors and see what they're doing. Talk to other investors, see what they think about the market, and rub minds and grow from there. There's so much to be gained when the market kind of slows down like this. This is the time when many people really make their fortune. It's when the market slows down and people stay away. That's when most savvy investors really double down, so that when the market picks up again and people are rushing in, people are just basically helping them to squeeze the market upward. So that's really, as an investor, that's how to look at the market. That's about what I wanted to discuss today with regards to inflation, interest rates, and how the market is adjusting to that, and how it relates to real estate, with how it relates to the real estate market. If you have any questions, again, please feel free to drop them in the comment section as I wrap up today. Again, my name is Joseph Ola. I'm a realtor here in the Southern Ontario area. I live in the Niagara area, but I serve Niagara, Hamilton, Oakville, Burlington, Kitchener, London, GTA. That entire area is my neck of woods. So feel free to reach out with any questions at all. Um, I will just hang back for a couple minutes more, just in case any other question comes in to answer them. Otherwise, I will call it a night. And yes, by the way, we will keep the show evenings from this week on. I think it works better for most people. So if you have any comments regarding that, if this time works better for you, leave a comment in the comment section. If another time works, well, still throw it out there, and let's see what happens. All right. Right. I see Sonny from Indonesia saying this time works better for for me. Yes, I agree with you. It's a good time to buy right now when the market sort of slows down a little bit. It's the perfect time to jump in because when the train gets going again, it gets really tough. So now truly is the time. Well, once again, thanks everybody for joining the show today. It's been a good time, and I hope you've benefited one way or the other. And sometimes it's quite encouraging when I see people, comment about what they've picked on the show. So please, even if you're watching the show later on, if there's anything particularly that really hit you hard, that made it for you a worthwhile show, please make sure to leave that in the comment section. Thank you very much. It's an awesome time this evening. God bless you all and have a wonderful week ahead of you. And see you next Monday, same place, same time. That's 7 p.m. Eastern time. God bless you. Have a good week.